Good morning, good afternoon, everyone. Welcome to our first edition of ARIVE Intellect. This is a new webinar series we have launched starting May 6th, where we will bring in housing experts on one common platform. We are really fortunate to have with us today two renowned experts in the space of non-QM. We have Scott Valins from GoRascal and Mike Smeltzer from Caliber Home Loans. Both GoRascal and Caliber Home Loans are very valued partners of ARIVE, so we greatly appreciate their support. We have a really packed agenda today, and this webinar is being recorded, so it will be available later for replays. If you have any questions, please use the Q&A tab below. So feel free to ask any questions you may have, and we will take them as they come. All right, so let me go through the agenda. All right, so the topic for today is non-QM, which we believe is highly timely and important. Non-QM market has really exploded, and we have two experts that will give you in-depth overview what programs exist, how they work, what you should be aware of, so that you can make a difference for your business and your customers. So I will start with a brief introduction. Maybe Mike, Scott, do you want to introduce yourself?
Sure, I'll dive in here. Thanks for reaching out. So my name is Mike Smeltzer. I'm the SVP of non-QM lending at both Caliber and the New Res company. I've been in the non-QM space for so long, I've forgotten how long it's been. I started in the non-QM space in early 2012-13 with Angel Oak and helped develop some of those early programs there. Then I moved over to New Res Caliber to start their non-QM agenda moving forward in 2021. I've been there roughly about a year. Previous to non-QM, I was underwriting manager, chief credit risk officer at several different other lending institutions. So I have an extensive knowledge of credit and especially the non-QM space. The non-QM space is a lot different when you're looking at it from a credit perspective, especially from an underwriting perspective, because it's truly looking at a borrower and doing what you would call scenario-based underwriting. Most of these loans, well, a large percentage of these loans will have some type of an exception to the guidelines attached to it. Just to kind of give you an overall idea of what that looks like, in our last securitization, roughly about 350 million in loans, somewhere around 25 to 27% of the loans had an exception. So to put that in layman's terms, 25 to 27% of the loans did not meet the underwriting guidelines, but there were other compensating factors in play that were strong enough to overcome the additional credit risk that you had in the file. So just because you don't meet all the specific guidelines in a non-QM loan, this is an underwriter looking at the true risk of the entire picture of the borrower and making a true credit decision based off all the attributes of the file. But that, that in of itself takes a special skill. So that's one of the things that you need to look for in a lender as you move along. But to wrap it all up, I run the non-QM space for both Caliber and New Res, and we will continue to grow this space as we move forward. And with that, I'll turn it over and let Scott introduce himself.
Thanks, Mike. You stole the exception idea off my list. That was one of the things later when we were talking about the pros of non-QM loans, is just how amazing exceptions are, because they're a lot harder in the other product types. Hey everyone, I'm Scott Valins. I'm the co-founder and CEO of GoRascal. We are a mortgage brokerage based out of Brooklyn, New York. Sitting here in my office in Brooklyn. It's got your classic exposed brick. That's not a background or an artificial one. Anyway, I've been in the business for 20 years now. I've only ever been a broker, stayed tried and true to the channel. And I've been doing non-QM loans for really, I think, since they, maybe 5-6 years, if I had to guess, since they really like came on the scene. They immediately were a boon to my business. My two biggest markets are, the New York City area and California, Los Angeles area. And there are just opportunities out of the gate to support these kind of non-traditional borrowers with non-QM loans. And we'll talk a lot more about why they are great products and what they do to help us brokers get more business. But excited to be here. Love non-QM and love Arrive and
Yeah.
Caliber.
Thanks, Scott. Thanks, Mike. That was a great intro. In fact, Mike, you went into our second bullet a little as well, which is great. Before we go deep, I do want to run a small poll to just get a sense of audience, what level of maturity our colleagues on this call have. So there is a poll that we have launched, which is asking a question: if you are not doing non-QM, why not? So we would greatly appreciate if the audience can take a few seconds and respond to this. Cool. So we see a flood of responses coming in. All right. So Scott, Mike, can you see the poll live as well, or on my screen, or not yet? Do you see the poll running?
We see the questions, but not the responses.
I see. So looks like about 58% of our broker colleagues have said they are actually doing a little bit of non-QM, but they want to do more. About 30% are saying, I have not done non-QM, but I really want to start. Almost no one believes these loans never close. That means the audience believes they do close, which is good. And very few are saying like they don't understand the market. So it looks like everybody appreciates the market. They understand what's happening. About 36% want to start doing non-QM. And the good part is about 57% are actually doing some non-QM, and they want to do more and make it as a part of their portfolio. So that's really good to know. Moving on to the next slide. So we appreciate doing this poll for us, everyone. So So Mike already talked about demystifying what new non-QMs are. So Mike, are these subprime loans? Are these hard money loans? What are these? Are there other myths that go with non-QM these days, or has been a? Go ahead.
Yeah, so I get that question all the time. Everybody says, "Well, is this the old subprime of the 2000s? Where you had no doc and 100% financing and some really crazy, unreliable lending going on in those days." But no, this is I would define this space as more alternative lending. Alternative documentation for income is what a majority of the programs are designed around. And the quality of the borrower is significantly stronger than you saw in the 2000s. And the reason I say that is New Res Caliber, we do securitization. So we bundle the loans and take it to Wall Street and turn it into a bond. So to give you an idea of what our borrower looks like, we just completed a securitization on Monday, and it was $350 million. So you have a significantly large pool of loans. Our average FICO was 750. Our average LTV was 70, and our average DTI was 31. That is an extremely strong borrower, no matter what type of program you're putting them on. Most of these borrowers have significant assets to be able to put down payment and reserves. Definitely have good credit history. The main program that you're going to see in the non-QM space by far is going to be your bank statement product. And the reason, obviously, that self-employed borrowers don't qualify is because they have access to many more levers to reduce their tax liability on their tax returns than a W-2 borrower would. And anybody that has access to those levers is going to take advantage of them, but they're doing that without the knowledge of how that's going to impact them when they go and apply for a mortgage transaction. So using the bank statements, you're able to see the cash flowing through the business to see if you're able to satisfy the mortgage debt. And in some respects, the bank statement calculation is much more real world or live and up to date of what's happening to the business. Because if you're getting tax returns, there's a possibility these documents are up to a year and a half old. And if you were in, a pandemic, those tax returns really weren't very beneficial when you're trying to figure out somebody's income, right? So it's very important to be able to see that there is a need out there for these clients, and we're able to supply that need for an underserved market. Non-QM that's what it's there for, and that's one of the main reasons it's exploding. Is these individuals have been told so many times that they are good borrowers. They have the equity, they have the down payment necessary, and they have very good credit scores to be able to qualify for a mortgage. That's what differentiates today's alternative lending versus the 2000s. In the 2000s, it was truly more of your credit risk, riskier borrowers with little to no down payment, no skin in the game. I guess you've heard that term many, many times. And with these borrowers having this amount of down payment into the transaction, if something were to happen, they have the time and the equity in the property to get out of a bad situation. Another reason that you see this space exploding tremendously is obviously the refi market has pretty much dried up. However, the non-QM market is starting to still be there because it's more of a purchase-driven market. But we're also seeing a large increase in cash out transactions, taking advantage of all the additional equity that has every homeowner has seen and taken advantage of since home values have increased so much so quickly. Being able to consolidate your bills into a lower payment with inflation can help ease some of the burden of your monthly cash flow that's going on right now. And everybody, I don't care who you are, you go to the grocery store nowadays, it just takes a big bite out of your everyday budget. So a lot of momentum going into the non-QM market, and because it's becoming one of these markets that everyone is just now getting to know and understand, there's still a lot of bandwidth out there of individuals that don't even know these programs exist. And we're in the business all the time. So we hear that, we see it on our LinkedIn feeds and social feeds and all this, non-QM this, non-QM that. The average borrower, they don't have access to, the knowledge that we have regarding the non-QM space. So it's up to us to be able to get the word out that they have access to credit. And that's one of the main things I teach my people to do, is just to get out there and be an ambassador for the space and teach people how to access these additional loan programs for that underserved market. With that, Scott, I'll turn it over to you and let you add on anything that I might have missed.
So Mike, I'm getting some feedback, like your voice is cracking out and some background noise. Is there something you can do? Like there is some background noise on your side, maybe static. This is for Mike. So go ahead, Scott. So
no, I was going to say Mike's incredibly thorough. It's everything he touched on I thought was very valid. But when it comes to myths, I think if I had to guess, some people that are really potentially afraid of non-QM or doing it and dabbling with it but not going all in is that there's a purchase-driven market. We all know from years and years of doing conventional conforming government loans, we know how to put our stamp on a pre-approval and take that file to the finish line, and our real estate referral partners depend on us and whatnot. When it comes to non-QM, you might say, what if I pre-approve this borrower, we're 2 weeks, 3 weeks into the process, and file gets declined, and I'm just not willing to take that risk, right? Like this is all about service and reputation, and I can't risk losing that realtor referral partner and so on. The reality is that non-QM loans are actually pre-underwritten by, I know Caliber will do a pretty thorough review up front of bank statement documents and credit, and almost an entire package, to the point where it's exceeded the pre-underwriting availability and access that we have on the conventional side. So you could bring a file into a non-QM lender before as a TBD underwrite, and in fact they encourage that, right? Because it's such a wide space and a newer space. Lending partners are almost all saying, hey, don't register your loan and clog our channel with files that might not work. We are requiring you to send in 12, 24 months of bank statements, get this questionnaire filled out. And so they are forcing you to have your file pre-underwritten, which means that you can go ahead and do that TBD before you have a contract on almost every non-QM loan that you think is, has the potential of going forward. And so kind of the reality is you don't have to be concerned about this deal going bust and you ruining relationships, because all of our lending partners, are, including Caliber, are set up to do that heavy lifting up front prior to registering and starting a loan. And that's massive. So that was kind of the main additional item that I thought when, when thinking about myths versus the reality.
Yeah, thank you, Scott. I think Mike explained the last securitization they did, the quality of borrower with 750 FICO, the DTI, the LTV. It really indicates these are really strong borrower. It is just they have alternate documentation by which they can be approved. So that was super, super helpful. So this is a good segue into what types of such programs exist and what type of borrowers these programs target. So maybe Mike, do you want to start with going through what types of non-QM programs exist and what type of borrowers might fit some of these programs?
Yeah, sure. That'd be great. So like I said before, the bank statement product is going to be the most popular product in the space. It accounts for roughly 50 to 60% of the entire market. So if you are going to, start into the non-QM space, definitely learn the bank statement program first. The benefits of the bank statement program, I know that if you're just starting as a broker into this, you're going to go, well, how do I go about calculating bank statement income? I know nothing about it. You don't need to know anything about it. We do the calculations for you. All you got to do is give us the bank statements, and we do all that heavy lifting for you and tell you what the qualifying income is, even before you've taken an application. If you have a borrower up front. And once we have done the bank statement income calculation, everything else is the same as a regular conventional loan. There's nothing really that much different. You get an appraisal, you get a title, give me some homeowners insurance, and close the loan. But like I said before, the bank statement product is going to be the most popular product. The 1099 is a product that is normally embedded into your bank statement product. So instead of getting 12 or 24 months of bank statements, you can give me less documentation, like a 1 or a 2 years of 1099. And we will do those calculations and add the correct expense ratio and then come up with the qualifying income for you. The next program is called asset depletion, or we also have an asset valuation program. How does that work? And what does the borrower look like? So think of this. This is a borrower that would be, let's say they're retired, they have lots of assets, but when you look at their tax return, they don't really show a lot of taxable income. They're very asset laden. So they don't show enough to qualify for a mortgage unless you use some type of alternative documentation product, such as an asset depletion product. For us, the asset depletion product does not have any income. We base it strictly off of the assets that the borrower has. So for us, to qualify for it, if you have enough assets to cover your down payment, closing costs, and the loan amount, plus 60 months of debt service, which would be your loans, credit card payments, and personal debt, plus 6 months reserves. And then after closing, after you put your down payment down and so forth, you have $500,000 still left in the bank, then that would mean you had enough assets to qualify for the asset valuation product. I've I've put some professional athletes on this program because they only had 1 year on their contract, or a whole bunch of borrowers that have a lot of assets, but for one reason or another, they can't show the 2-year continuance of income, but more than enough assets to cover, and make sure that they would be able to satisfy the mortgage debt. The next program is probably one of my favorite programs. It's called the Investor Cash Flow Program. And on the Investor Cash Flow, hold on one second, I got some background.
So as Mike fixes this, so Scott, from your experience, what programs you have been doing over the last 12 months, given this market is exploding? Can you talk about some of the popular programs practically that
sure.
you have deployed?
Sure.
So,
yeah, so like Mike said, bank statements by far and away the most popular. I run into borrowers left and right who will start at another lender, a big bank, and they'll be denied right out of the gate. They give them 2 years tax returns and it's not even close. And hopefully they end up in my inbox or on my desk through a referral, and they have no idea what the bank statement program is. They've never heard, they couldn't believe there was an alternative. And it's the easiest, obvious alternative and solution to self-employed borrowers who can't qualify with their tax returns. And I'll let Mike hop back in, but the asset depletion loan, a lot of people think, well, if someone's got several $1 million in the bank, an athlete or whatever, isn't there a high net worth, private banker, going to give them a loan? The answer actually is often not, because these are conservative institutions that want to see some significant income, and maybe the assets can top it off to get there. But if someone's got, I was working with someone who's transitioning businesses and had nothing and had the assets, and I think they had a large portfolio of assets with both Morgan Stanley and different big investment firm, and neither of those companies would lend on their loan because there was no documented income at the time. And so it's often another myth, kind of saying like there's no opportunity in that high net worth asset space because a big bank, whoever's holding those assets, is just going to give them their mortgage. Not often, that's not the case if they don't have any income or a decent amount of income.
So true. And another way is to partner with a financial planner, because a financial planner will not want their clients to go to a large bank, because they're going to solicit them to put the money in their bank. So they would want you to go to a private lender such as a Caliber, because we don't have deposits. So
I actually got that deal from the banker himself, who said, we won't do it. Customer's irate. He's threatening to move his money. I don't want him to go down the block to Wells Fargo and see if he moves 5 million over to them. Maybe they'll do it. He's like, can you get this guy an alternative loan? Like, please don't make me lose my portfolio. So spot on.
Absolutely. Scott, tell us a little bit about the agency turndowns. I know you run across that quite often.
Yeah, for sure. I think the agency turndowns largely stem from either call it a turndown or just not fitting the bucket. Sometimes high LTV multifamilies, right? We all know that 2 to 4 family, I think, tops out at 80 on purchases, 70 on cash outs, I think, on the conventional side. And so, there's typically a non-QM product out there that'll push that a little bit higher, go to either 85, 90. There's often some, remember with all the whole non-QM space, there's no AUS underwriting. There's no machine or computer making a decision, as Mike kind of said out of the gate. Exceptions are available left and right. And so some credit blemishes, BKs, things like that have standard waiting periods. There are, in the non-QM space, there also are like kind of standardized waiting periods as well, but they're usually less conservative, a little bit more friendly to the customer. And then, of course, the non-warrantable, condo space. You just, non-warrantable immediately tells you no to anything agency or government, and non-warrantable opportunities are available in non-QM. I won a piece of business. New York's an attorney state, and I had an attorney, a buyer's attorney who I work with, refer me to another buyer's attorney who said, help, we have this client who is, he had two things. One, he absolutely needed a bank statement loan because he was self-employed, so he couldn't even get qualified on the credit side, but it was new construction, and only, I think, 2 units had closed in the building out of 8 or whatever, and he needed to close and was striking out left and right on the retail side. And I was able to bring that deal in and close it as a non-warrantable condo and as a bank statement loan together. So the non-warrantable space has been helpful over the years, very much so. So yeah, there's, the thought process is, the minute it is an agency turn down, as you're pre-underwriting it or whatever, it's, you want to be trained. Okay, let me transition over to the non-QM space and find the niche, find the bucket, and more often than not, it will fit in somewhere, and you can be a hero.
Yeah. So the last product here is the I-10 Foreign National. Definitely a very niche worthy product. It is definitely designed for like a lot of people don't understand the definition of a foreign national. So a foreign national is truly someone that lives and works in a foreign country. So those individuals do take advantage of the real estate market here in America because it's a more safe place to have an investment with a return if you live in a foreign country. The United States is by far the best financial system in the world, so it's a good place to to earn a rate of return. The I-10 is an addition to most full documentation offerings to get those borrowers that may not have all of the documentation necessary, but they have an I-10 and they do have credit that you can pull using the I-10. A very, very good product for specific areas of the country that have high populations of I-10 borrowers. But that's going to be the basics of the market, and it's still expanding. That's the one thing about non-QM. There's always going to be an opportunity for non-QM lenders to look for the underserved borrowers in the market. So these offerings are going to continue to expand in a very judicious way. In other words, you can't do it just willy-nilly like you did in the 2000s because there are checks and balances in place, but you will see expansion of products going forward. One of the things that I heard from some of the Wall Street banks before the pandemic regarding the non-QM space, the delinquency on these programs had always been excellent, just a tick above agency, but like I said, 2 to 3 times better than FHA or VA. But I would always get them telling me, but your products have not been tested yet. In other words, a downturn in the economy, whatever. Well, I would say the pandemic was a pretty big test, right? In the beginning, you did see the delinquencies kind of tick up in the beginning, but then they came back to historical levels. And now the products have been called what you would say tested. So these are well-performing borrowers. You can sell these programs with confidence that these are well-performing products. Anything else, Scott?
Yes, so we got some great questions. Maybe I'll take them for Mike and Scott, both of you to answer. So the first question.
We didn't cover DSCR though. I think we should, because that's
we should
kind
cover
of my
DSCR.
favorite product. Did you want to wait on that?
That was one of the questions. No,
yeah, we
ahead,
just
Scott.
skipped over it. Yeah, DSCR is like almost too good to be true. It's when it came out, I don't know, so many years ago, and I don't do commercial lending. I used to dabble with it a little, and like you try to get a commercial loan through, the DSCR underwriting, debt service coverage ratio. It's like, I'm glad I'm on the residential side. It's like impossible to close those loans. Yeah, DSCR is simply, it's for investment property only. Your gross rents on the property, gross, literally the amount being collected from the tenant has to be well, not had, there's many iterations of it, but it used to be that it has to be, equal to or maybe $1 more than the PITIA if it's a condo on the property. Now, like Mike said, as these loans have performed well through very challenging times, they've dropped that to the point where in some instances, your gross rents could actually be less than your housing payment on the property, and they'll still fund the loan. And that's all they look at. There is no DTI. They're not taking into consideration your personal income or your personal PITI on a place you own, or any of your other real estate assets and how those are doing. It's isolated exclusively to the property itself, and it's an incredible product. I mean, I think as we all watch what's going on in the overall residential space, and for better or worse, you read about how big of a market share the investment world is taking, the investment property spaces within the overall residential space. That's the reality, right? It's, people are investing in real estate now more than ever, residential real estate. And so product's incredible. Investors don't want to turn over 20 LLCs and go full doc and qualify. They want the property to cash flow. There's no interest only product on the conventional side for this. There is on the non-QM space. And so they're largely unconcerned about the interest rate. They love interest only products. It's an easy loan. I love DSCR loans, and I wouldn't say they even save loans the way bank statements do, but they create loan opportunities right out of the gate. And so, yeah, it's the clear number two. I don't know, Mike, statistically, you said bank statements 50, 60. I'm guessing DSCR is another 20, takes another 30 on top of that, right? And then the rest is, yeah.
And the other reason that I hear all the time of why people, especially investors, are using this product is ease of use. For give you an example. So if you have 20 properties, right? And you're trying to get a conventional loan or whatever, you have to go get your HOI and taxes for each of those properties. And by the 15th time the processors called you and told you you missed the HOI on 123 Main Street for the 5th time, you're ready to jump off a building.
So is the borrower.
Yeah. So ease of use. I've had many borrowers that financially they could qualify. Credit-wise, they could qualify for a Fannie loan. They just didn't want to go through the trouble, because you don't have to supply all of that unnecessary documentation for a DSCR or investor cash flow. It's truly an ease of use. They understand, the people in this space understand cash flow. They understand payment. So if you're able to fit that payment into where they see that on a monthly basis they're going to make money, that's what they care about.
And don't forget, no cap on, you're not capped at 10 finance properties typically on this as well, which is a big restriction on the agency side.
Yep.
Cool.
So true.
So we have some great questions which have come in. So this was one of the questions Tim asked about DSCR. So thank you, both of you, for giving more insights on that. So Mike, do you want to just go through, Caliber has smart series programs. So how does Caliber support all these programs? And maybe touch base a little on what kind of, DTI ratios or FICOs or LTVs you guys are looking for. So
for the bank statement product, our program is called Smart Self. We have a 12 and a 24-month bank statement program with the 1099 embedded into the Smart Self. We go up to a 90% LTV. We have up to a 50% DTI, which can help you in today's inflationary market qualify the borrower. We go all the way down to a 640 FICO score. We capture those borrowers from beginning to end, pretty much. On the asset depletion or the asset valuation program, that is embedded in our full documentation offering, which I call a just miss jumbo. That is going to be called Smart Edge for us. It's a great program for those jumbo borrowers. As we all know, jumbo guidelines are straight down the fairway. You can't go left or right. It's very hard to get an exception for a jumbo loan. So these loans normally have some type of income component that they need some additional income to qualify, that because of the guidelines and how they're written for a jumbo loan, they fall out. Where we are have a little bit more leniency for the income documentation needed, and we're able to include that additional income and hence to qualify the borrower. And in addition, we go up to a 50% debt ratio for that program, where for a jumbo, a lot of them are cut off at 43 or 45, depending on the programs that you're using. The DSCR, or the investor cash flow, for Caliber, we call that the smart vest, that's investment properties, right? So we'll go up to an 80% LTV for that program. And our DSCR is at 1 currently. We're looking at expanding that in the next few months. So what does that mean? So if you have $1,000 of PITI and the market rents on your appraisal say $1,000, that's a 1-to-1 ratio. So then if you met the FICO requirements, you qualify. I mean, it's a very ease of use loan. And in today's market, the borrower is not going conventional for this, that uses this product. They're using hard money today. And once you're able to get into that space in your market, it's a small space because these individuals talk to each other. It will be a self-sourcing type of loan, and it isn't a one transaction type of deal. It's going to be multiple transactions because normally these individuals either need access to their equity to add to their portfolio, or they need to update their portfolio by taking cash out and enhancing their properties using the Smart Vest program. And for the Foreign National program, we have embedded that into our Smart Vest. So there's no income component, which is always, it's always difficult on some foreign national programs to document the income. Since we put it inside the Smart Vest, we've taken that hurdle away. And we'll go up to a 75% LTV on a foreign national program. And so we're this close to launching it. And we should have that out probably within the next 30 days. Like I said, this product mix is always expanding. It's always looking for additional opportunities out there to look for the underserved market that have been told no so many times. And they're very, very grateful borrowers. I mean, I'm sure, Scott, you've heard this many times. Some of my loan officers say it's some of the most rewarding lending because you're truly helping someone that really thought they had been locked out of the American dream of owning their own home. And it's, it's really, it helps get up the next day to do that fight, because it is a tough business.
That's what
I
just put in my notes already. Also, very happy customers. It's true.
Yeah.
If you're saving a deal or surprising someone, they didn't think something could work. And you also come across some very interesting people, because non-traditional, unconventional loans, bring on unconventional people. So you get to know, people a little bit outside of the, the W-2 wage earner box, which is always fresh, like you said. It's fun to wake up every day and work on those loans.
That's so amazing. I think another point that I wanted to make, Scott, you alluded to. So rates are generally higher, but most of these non-QM programs do have interest-only options available for 5-10 years. So that makes a big difference. So even though the eventual rate might be higher, but like you mentioned, Scott, borrowers are not that much concerned because an interest-only option is generally available for most of these programs. Totally. We also have a lot of questions on guidelines. Like a lot of users, our guests are asking when to use 1099 versus bank statement, or specific questions on DTIs and reserves and number of years. So I would suggest, given we have a lot to cover, if time permits, we'll come to guidelines towards the end. You can always contact your account exec at Caliber or any lender. They will give you a rundown of the exact guidelines. And these are story loans, as we call them in-house. So every loan has a story and exception friendly. So if a borrower is not meeting certain criteria, just work with the lenders. I'm sure there'll be an exception available if there are compensating factors. So I'll move on. If time permits, we will come back to all these specific guideline questions. And Scott, are there any other real world examples? I think you already explained many of the loans you have done. Are there any other examples you want to point out for our guests where the loan was not doable, but you came in and, saved the deal, became a hero. So
Yeah, I shared the non-warrantable condo example. I mean, that was a great recent one, but the bank statement loan really ends up being, so often, if you're not the first person to work with the client, the first person for them to come to, then it's a save. It's like it's a real world save the deal, because luckily they're finding you. But in a lot of places, there's a massive need for realtors to be educated on these products, because there's nothing wrong with, well, there are many things wrong, but there's not really much wrong with people going directly to a big bank or whatever. If they can get their loan, great and whatnot. But oftentimes they get referred to, an agent's lending partner at a big bank, and they get turned down, and they think it's game over from there. And so it's all about educating the referral partners to say, okay, they said no, talk to Scott. I believe he has some other products that might work. And when it's a bank statement loan, when it's a self-employed borrower who was being reviewed only for their tax returns, the bank statement loan almost always works, because of the 50% standard expense ratio, right? If you have $500,000 in deposits over the last 12 months, the standard expense ratio is to give you 50% of that on paper. But there's opportunities to move even higher and use 60, 70% with, a letter from a CPA or whatever. But it's pretty rare that, we'll run a bank statement scenario after someone couldn't qualify with their tax returns, and it's worse than what their tax return maximum borrowing power was, or that we can't even get them into that property they were hoping to write an offer on. Because most people that run successful businesses have the revenue, they're just savvy about reinvesting their profits, or taking appropriate expenses to reduce their taxable income. So yeah, bank statements, name of the game when it comes to saving deals. And it's frequent, and yeah, it's a foot in the door for referral partners as well. Like I just said, a lot of them don't know about it, so it's great talking points, great opportunity to get on the phone and share these things with new and old referral partners. A lot of times you scratch your head and say, I really want to call this this realtor and ask for business, but like, what am I going to tell them? How do I stand out? How do I differentiate myself? This is the differentiator in our space right now. That's an unbelievable opportunity.
All right. So as I go into my next question, so we have talked about all these amazing programs that exist, which will serve almost every borrower from a opportunity perspective. So as maybe I'll start with Scott. So Scott, as you are looking for lenders or investors who can service these borrowers from a non-QM perspective, what do you look for in a lender partnership, and how do you train your internal staff to process these loans or work on these loans? Are there any best practices you can share over here?
Yeah, sure. So, this is not just a kiss up to Caliber, but I'm all about using non-QM lenders that actually operated in the space prior to non-QM and have a regular agency product and program. Don't get me wrong, there are some fantastic non-QM lenders out there that only do this, that only ever did this. It can work. But there's also a lot out there that have figured it out and gotten into the space and offer some really good products and programs. And but it's a space that can sometimes run into some challenges with Wall Street and buying the loans at certain rates and stuff. Whoever's listening in knows what I'm talking about. If you've been in this space for the last 4 or 5 months, there's been some scary moments. But when you're working with an established entity that is diversified on their product suite, does everything else, Fannie, Freddie, Govy, VA, and has a very long-standing reputation in the overall lending space, that they're ultimately going to do the right thing when things might get challenging. And so and you also know that they have a strong existing operation that these products can just plug right into. Because like Mike has said, once you get past the bank statement calculations or whatever, it's really just a regular loan. In fact, it's an easier loan for an underwriter to work through. So I'm generally, especially if you're just getting into this space and you're like, who's the first lender I should call, whatever, Caliber, a lender that has been around for a long time and can weather little mini storms or whatever. I think that's absolutely critical. Training and operations, lean on your lending partner, your AE, There's videos, there's specialists like Mike, but of course, people that, that work for him that know these products inside and out, and will hop on a Zoom with your sales team, your processing team, walk through not just the products and what their guidelines are and whatnot, but how they operate within the space. Like Mike said, uploading a package before you take an application, all those things. So really, I mean, you don't have to do much. You can lean on your lending partner like Caliber to really bring you into the space and educate you and get you going.
Anything,
you,
Mike, you
Scott.
would like?
Yeah.
Go ahead. Go ahead, Mike.
Thank you for the kind words, guys. Greatly appreciate it.
25 bips off on my next 10 million, please.
Exactly. You go right to the front of the pile. So just kind of tag on a little bit to what he said. As we see, a lot of lenders are getting into the space. It is not an easy space. If you don't have individuals that understand and know how to train their underwriters to be able to scenario-based underwrite a loan, that could cause a lot of unnecessary additional conditions, or maybe not even getting the approval. We've been in the space for a very long time. Our underwriters are very seasoned and they understand scenario-based lending. And some of the additional tools that I'm able to provide for anybody that's on this podcast, if you're just looking to get into non-QM lending, or maybe you did one 6 months ago and it's kind of just, you don't have the necessary knowledge, maybe. I have a whole team of business development managers that you can reach out to that can walk you through the entire process. And like Scott said, they can get on a Zoom call and train your processing staff of how to do it, how to upload for bank statement income calculations, or just help you walk through the entire process. And they're there for the entire process. So if something were to go wrong, yes, you have your account executive, but you also have the business development manager to lean on to help push this loan over the finish line. It's a very valuable piece and a necessary piece. So those are the individuals that I have tasked from Caliber to get the word out, to get the word out that people that may have given up on the American dream, there is an opportunity to serve that underserved market and help truly deserving borrowers. These borrowers are, I mean, I think we've established they are well-deserving customers. It's just we need to, find them and be able to, put this right product with the right borrower and get them in the home.
All right. Thank you. Thank you, Mike. Thank you, Scott. So I want to move into another question that comes up, at least we see that often in terms of appraisals. So do these loans require any special appraisal, anything unique about them? Are there waivers available? So maybe Mike and Scott, do you want to chime in on what kind of
first? Go ahead, Scott.
All right, I'll take a stab at it. Yeah, so no waivers on non-QM appraisals. Got to have an appraisal on every transaction, but they're not unique. They're on the same forms that are required on Fannie Freddie products. So yeah, in the DSCR loan, for example, the appraiser is going to do a rent roll, and underwriter is going to take the appraiser's opinion on a vacant unit, for example. That will actually be the rent, the driver of the usable rent. Mike can correct me if I'm missing some specifics about it. And I think you even get that when you have an existing lease. They're still going to ask the appraiser to do that to kind of validate the income that's being reported on the lease, because you're not showing anything else when it comes to rental income. So yeah, no, appraisals are just the same. I would say they're how they're interpreted as far as deferred maintenance and stuff leans more towards the conventional space than the govy space, right? Chip paint, things like that hold up appraisals on VA and FHA loans. You don't have to worry about that as much. Correct me if I'm wrong on non-QM. They're more interpreted along the conventional lines. Is that right?
That is correct. And I can add a little bit about, so back in the 2000s, there were appraisal waivers for Alt-A type of lending. That's another reason why the lending today in this space has been strengthened. Every loan that's going to go into a securitization will have an appraisal. It's just, or you won't be able to securitize it unless you have it. Actually, a lot of people don't know this, but we also have to get an AVM, but that's normally done after closing. But there's actually two values that go into a securitization. But like I said, that doesn't really affect the broker. The broker world is done before the securitization. So just to validate that the value is accurate for this transaction. The last thing, kind of wrap it up on this, is I get this question a lot. A lot of times people look at the alternative lending in non-QM and think that we will combine that with a property that Fannie Mae won't do, like, I don't know, a geodesic dome or something like that. It would be the exact opposite. Because you're already doing alternative income calculations, you're not going to combine that with an alternative home. That's just layering the risk to a point. So it's really, think of the homes that would fit on a Fannie product would be the same that would fit on a non-QM. Anything outside of that, we would always want to take a look at it, but on the norm, it needs to be something that would fit into some type of a Fannie transaction.
All right, thank you, Mike. So my next question will be for Scott. So Scott, are there any best practices? How do you source and market to these borrowers? Where do you go and find them, given we all agree they're exploding and they're all, so how does a broker go out and find these borrowers?
Yeah, so I think I alluded to it a little bit a few minutes ago. I think, it's just an amazing and unique talking point for existing realtor partners and any new ones that you want to, go out and grow your business with. An easy way in the door is to say, hey, I'm not trying to replace your existing, go-to lender. But if they don't do QM, then I want to be, the second opinion or second option every time you hear that one of your buyers can't, get approved by the other lender. I think it's just a beautiful way in the door. And the first deal you save when it happens, you can easily inch your way up to the pole position by impressing the realtor and all the other ways that we try to do as brokers. So that's that. Mike alluded before, this is a great, all these products are great for also networking with financial advisors and CPAs. Anything on the financial side is great because they know what's going on. They're the first to know that tax returns aren't going to qualify. They're very aware of the size of the portfolio investments for these customers and buyers. And so really across all referral partners, there's something to talk about. CPAs, financial advisors, real estate agents, divorce attorneys, everything. It's just it's a great and viable and competitive enough alternative that no people say, yeah, but this part doesn't work, or I don't like this, or whatever. And just one thing to say about the rates is, I remember as I've been selling these loans, when rates were in the, the twos a year ago, 6 months ago, even maybe, selling these in the high 3s and 4s was, people are like, wow, that's amazing. Like, great. And now that, prime rates have gone up to the 5s, we're selling these in the 7s and whatnot. It's a little bit of a harder sell these days because people had seen 5s before, right? So when these programs were 5s, when everything else was 3s, they're like, oh, 5, it was 5, 10 years ago or whatever. It's getting a little bit harder, but if you explain it properly and you remind them that, prime stuff right now is in the 5s, this is just 150 basis points higher, whatnot, and opportunities to refinance in the future. If it's a bank statement loan, and you talk to the person how they've just had a couple of challenging years on paper, but 2022 and 2023 is going to look great. I'd like to discuss the refinance potential. And I was discussing this when rates were at their bottom on non-QM loans. Now that rates have moved up a lot, I think we're all confident at some point in the future, rates will move back down to a degree. So you go from a non-QM loan to a QM loan to a prime loan and a drop in rate. you'll have another opportunity to work with that customer again. So it's a little bit of a harder conversation, but it's if you frame it properly and educate them. Listen, these people, like Mike said, have been left out of the homeowner, the home owning, opportunity field for many years now, and so most of them are just excited to get into this home or add that additional investment property to their portfolio.
And another good referral source, Scott, you mentioned business bankers or commercial bankers. You mentioned a good example. You have 5 million in the bank. You don't want that to be moved out. So, our brokers networking with commercial bankers, that probably is another good source of
commercial bankers and retail loan officers as well.
Yeah. Mm-hmm.
Just don't have this product suite yet, at least. So absolutely. Yep.
All right. So thank you so much. So I'll move into our last kind of question to wrap it up. I mean, no one has a crystal ball. Nobody knows where rates will be. Maybe Fed knows, but no one really knows where rates will go in next 3-6 months. But where do you see this market headed? Like, we are seeing a growing number of borrowers who kind of fit the non-QM bucket, if you will. But where do you see, will this market continue to expand? Will this plateau out? Are there thoughts about any future prediction or trends in the non-QM space?
So yeah, one of the things that you're going to see in the non-QM space, it is going to continue to grow because a lot of mortgage banks are making it a big part of their overall business plan since the refi market has truly kind of dried up. So where is all that additional business going to come from? So a lot of banks are really starting to embrace this market and dive in for the first time. So the overall offerings are going to be a lot wider. So you're going to see the non-QM space grow. One of the things that I see here, once all of these margins kind of settle down, I do see that non-QM will start to expand a lot faster. And you will see other offerings coming into the market as long as you're able to show that it is going to be a proven type of program. But you will continue to see this space expand over the next year to two, for sure. It's just at its infancy, just beginning, just kind of getting that momentum going for the first time. But every time we see the momentum start to really spin, something kind of puts it on hold for a second. Last couple of years, it was the pandemic. Then non-QM came back and started going really fast, and now rates have kind of slowed it down a little bit, but it will eventually start to pick up again.
So Scott, what are your thoughts? Where do you see trends given what type of loans you are doing?
Yeah, no, I agree with Mike. I think also the profile of the home buyer has become a lot, there's more self-employed, gig working, startup, small business startup, people in the workforce now. I think more than ever, the pandemic forced a lot of people, or not forced, led a lot of people to make a decision to, go start their own thing or do this and that. And that's what the non-QM space is, especially the bank statement program is like perfect for. Some of these nascent businesses that aren't turning huge profits on paper, but are doing quite fine and are well run, will only be able to qualify for an alternative program. So I only see it growing. I'd be interested, or I will be interested to see once rates chill out and whatever, see if like the spreads between non-QM and prime stuff tighten back up a bit. They were very tight, 4 or 5 months ago. I think the lowest non-QM loan I locked a 3 1/4 30-year fixed with some good yield spread in I don't know, maybe late fall or something. And so not expecting those kind of numbers, but I think it'll be interesting to see if the spreads tighten a bit. So it sounds like the loans are performing really well, and Wall Street likes the paper a lot. So no, I'm excited about non-QM and more than I ever have been, and it's great to hear that more products will come. I'm interested to see if there's a brand new product or just kind of spin-offs of what these core products already are. But it's great. It's a great alternative that literally wasn't here 5-6 years ago, and we were all playing in that same sandbox, and here we are with this kind of unlimited opportunity with non-QM loans.
Thank you, Scott. So we are at the top of our time. Again, I want to thank our panelists for taking time off their schedule to come here and talk about non-QM. We hope our broker guests got something out of this. So it's good to see 60% of you guys already doing non-QM. So hopefully you have learned something where you will trial some new programs, some new product, go after, do some new training programs internally for your team. And 40% of those who want to start doing non-QM, hopefully this session was valuable. Again, thank you so much. This has been recorded and the recording will be circulated to everyone who registered. Thank you for your time.
Thank you.
Thank you.
Thank you.